The US economy has been very resilient in the face of economic challenges thus far in 2023. But Jerome Powell is sounding the alarm on 4 major political economic threats that could push us into a recession. These challenges include the possibility of a broader auto workers strike, a lengthy government shutdown, the resumption of student loan payments, and rising oil prices. And because these 4 economic threats could potentially occur at the same time, it could really disrupt the economy, especially as it begins to cool as a result of higher interest rates. And so as investors, we need to be aware of these 4 economic threats, and that's exactly what I'm going to cover in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now, most people really did expect a recession in 2023. We had higher interest rates that actually pinched the consumer spending really declined, and it really led to large layoffs, especially in the tech sector. But now we're seeing layoffs in other industries as well. But of course, despite the higher interest rates, the economy really remained resilient thus far in 2023, and it really speaks to how robust the US economy actually is. Robust consumer spending and low unemployment have supported the US economy despite the Federal Reserve's efforts to combat inflation by rising interest rates. And the economy even proved to be resilient even in the face of a potential regional banking financial crisis issue that we dealt with in the spring of this year, which of course did create a wonderful opportunity for value investors, which I covered in detail on this channel. Now, moving forward into the last few months of 2023, analysts expect slower economic growth in the coming months, but they don't expect a recession. Growth estimates do vary, with some predicting a sharp slowdown to around 0.6% annual growth for the fourth quarter. However, as we move into 2024, investors are forecasting that there is a 70% chance that the economy enters into a recession by May. This is why compounding issues could actually weigh on the potential for a soft landing, especially as the economy is already cooling due to higher interest rates. So let's get into those 4 economic threats. The first economic threat is a wider and more prolonged strike by the United Auto Workers against 3 Detroit automakers. Recall that nearly 13,000 workers began striking 3 plants on September 15, and the UAW president Shawn Fain said recently that the strikes would expand to 38 General Motors and Stellantis parts distribution centers across 20 states. So this thing could potentially grow. Now, I think the initial impacts of the strikes are largely limited, but I see 2 really big and important risks here. The first risk is a broader work stoppage that could curb auto production and drive up vehicle prices higher than they already are. Recall that motor vehicle assemblies have just recently caught up to the pre-pandemic levels, which has served to catch up to market demand. This finally started to increase the affordability of vehicles for the average consumer, but of course, if you have more widespread strikes, supply will once again be constrained and affordability will of course decline. The second risk, and a lot of people are not talking about this yet, is that the auto workers that are striking could potentially lose their jobs. This may not seem like a big risk at first, or even a risk that anybody's talking about right now, but note that automakers and their suppliers are America's largest manufacturing sector, responsible for 3% of America's GDP. And let's be clear, no other manufacturing sector in America has as many jobs. Not only are they America's largest exporters, they also buy hundreds of billions of dollars worth of American steel, glass, rubber, iron, and semiconductors each year. They are among America's largest investors in research and development. So there is a serious potential economic issue if these strikes are allowed to continue and spread. And I know a lot of people aren't paying attention to the strikes thus far, but be very careful. Now, the second economic threat could be the potential for a government shutdown. The Republican Party is currently failing to pass a vote to advance spending bills that would avoid a partial government shutdown by the end of the month. In December of 2018, a similar standoff caused a 5-week partial shutdown in which the government funded some agencies and not others. Roughly 300,000 federal workers were furloughed. It shaved 0.1% off economic output in the fourth quarter of 2018 and 0.2% in the first quarter of 2019, according to the Congressional Budget's Office. If they can't reach a deal, this would mean that as many as 800,000 people nationwide could potentially not be at work. Those workers would likely spend less during the shutdown, and the government would temporarily buy fewer goods and services. So overall, I think the potential for a government shutdown is higher than we think right now. Just because we've gotten through them previously this year doesn't necessarily mean that we're going to get through this one. And so let's see how this plays out. But there could be very drastic impacts here that could take down the stock market. Now, recall, guys, that the previous government shutdown risks actually did bring down the securities markets, and so you could potentially have that again. Now, the third economic threat, or bump to the economy, if you will, is that federal student loan payments are going to start to be getting repaid once again on October 1st. This will be the first time many borrowers make payments since March of 2020, when the Education Department paused these payments to help cushion from the financial effects of the COOF. But let's just put this all into perspective. The monthly payments for the tens of millions of student loan borrowers affected averaged between $200 and $300 per person monthly, and these make up a small slice of the $18 trillion of annual consumer spending. However, you've seen me many times on this channel explain why many companies are expecting a consumer headwind as a result of the resumption of these student loan payments. So despite the fact that it is a small amount of overall consumer spending, you can see that companies are worried. Now, overall, I think that this risk could potentially be overdone with respect to the securities markets and how some of these retailers are being valued. And so I am bottom fishing here. I am picking up some strong retailers as their valuations do come down. Now, the fourth and final economic threat that you need to be worried about is higher oil prices. Since midsummer this year, the price of oil has shot up, and there are no indicators that it will decline in the near future. That caused consumer inflation to edge higher for the second straight month after trending down the prior year. Elevated energy costs cut into American budgets for dining out, holiday gifts, and other discretionary purchases. They also can feed into prices for goods and services that are manufactured or shipped or flown. And I think overall, the key takeaway here is that one or two of these issues are very manageable. However, when they start stacking to 2, 3, 4, 5 potential issues, overall, I really think it could disrupt the soft landing that we're going for. And then nobody really knows what the economy could potentially look like in the future as a result. And so I want to know what you guys think. Let me know in the comments below which of these 4 issues you should be worried about and how you're addressing them with your portfolios. I respond to absolutely everyone. So let me know in the comments, guys, and I'll see you later.